Thank you very much, Joe, for doing this. We're going to talk about
pleasure.
AVI Global Trust. So, as per usual structure of this, do you want to start off by introducing a bit about the fund and what it's trying to achieve, please?
Of course. Thank you very much for having me on. By way of background, what I would say about AVI Global Trust is that our objective is to achieve capital growth by investing in a concentrated portfolio of equities around the world. We're particularly interested in areas of the market that are neglected or overlooked and inefficiently priced by other investors. So we're trying to create a portfolio that looks somewhat different to most other global portfolios. And we're doing that with an asset base of almost £1.2 billion. We've been running the trust at AVI since 1985, and I personally took over as lead manager in 2015.
Cool. And then I think you've got some figures here. So quite some conservative management fee. And then you are trading on a discount. I think one of the things we should explore is the sort of double discount thing on the portfolio.
That's right.
There's the discount here, chart here. So on your portfolio, you're buying companies that are trading at a discount to what you think they're worth. What sort of companies is it that are going into the portfolio?
Okay, so we are interested in companies trading at discounts to net asset value. And those types of company range from investment trusts, investing in other investment trusts that will be very familiar to your listeners. And clearly those do trade at discounts to NAV, and the NAV is readily discernible, and hence the discount is very easy to calculate. We also focus on other types of companies, principally family-controlled holding companies. Now, these are listed companies. They're found around the world, pretty common in Europe and parts of Asia, and to a lesser extent in the US and other emerging markets. They tend to be a bit like investment companies, but they run portfolios that are more concentrated. They can be a mix of listed assets and unlisted assets, and typically families will be the largest shareholders. In those cases, depending upon what the underlying assets are, the discount and the NAV calculation may be more or less straightforward. But yeah, I mean, we're interested in buying companies around the world trading at discounts. We measure those discounts over time, and the chart that you have up there shows how the portfolio weighted average discount has evolved since 2006. And that is totally separate to the discount that you pointed out, at which AVI Global Trust's shares trade at, the 11.7% that you showed earlier on. And taken together, those two figures, the 35% that the portfolio is trading at plus the 11.7% that the shares are trading at, gives you that double discount.
So basically, you're almost buying things about half of what they're worth.
Today, absolutely, that is right. Yeah.
Yeah, exactly. Great. Okay. So what is it that drives the moves in the discounts then?
Okay, so to a large extent, changes in discounts reflect pessimism and optimism in the market. So you can see here by looking at this graph here that in 08 and 09, discounts spiked out towards between 35 and 40%. Again, during the Euro crisis time in 2011 and 12, we hit those levels. And again, in 2020, with the COVID sell-off, we reached really unprecedented levels of north of 45%. So today, with the volatility in markets and the weakness generally that we've seen over the last 6 to 9 months, we're back out north of 35%, and that's moved out from the mid 20% level that we were trading at the end of 2021. So to an extent, across the universe, discounts reflect what's going on in broader markets. However, beneath the surface, and this is really what we're we're trying to do with our portfolio, beneath the surface, there can be a range of other catalysts that lead to discounts narrowing or widening in individual situations. And our objective in buying companies trading at discounts is to benefit over time from the double whammy of strong NAV growth. So to buy good companies that are going to appreciate in value, but to buy them on a discount and to benefit as well, and to derive an additional source of return from the narrowing of the discount that could occur during our holding period.
So it's important that they're decent quality companies in the first place.
Yeah, we don't want to be buying companies that are perhaps trading cheaply, maybe trading 50, 60 pence in the pound, but that pound of value is declining every year or not really appreciating. So we want to be buying companies that pound is going to grow over time. And in addition, benefit from buying them cheaply and benefiting from the narrowing of the discount. Now, things that could lead to narrowing of the discount, if you think about an investment trust as a straightforward example, an investment trust trading at a discount, were it to liquidate its portfolio and return a pound of assets back to shareholders, that would be one way of eliminating the discount. In the cases of holding companies or some of our investments in Japan, it's a little bit more complex, but amounts to something similar. In essence, either returning capital or being more proactive in terms of pushing the share price up and narrowing the discount by buying back shares, by distributing assets in specie, or by listing unlisted assets so that the market can fully understand the true value of those underlying businesses and just improve sentiment and help narrow the discount.
Okay. I've got the portfolio up here. So actually, it's an interesting mix of things. Maybe we can talk about. So there is a big, relatively big exposure to Japan. So can you tell us a bit about what the attraction of investing in Japan is, please?
Yeah, absolutely. So Japan's become an increasing exposure for us in AVI Global Trust over the last 4 or 5 years. And the background to that really is that Japan has for many, many years, a couple of decades actually, looked to be a cheap market, an attractively valued market. But for many, many years, companies there remained cheap. Nothing ever changed. And there was no catalyst really for that to change. So it was almost like a value trap. But about 5 years ago, we noticed that companies' attitudes, management's attitudes towards shareholders were shifting. And that really was down to Abenomics, the 3-arrow policies of Prime Minister Abe, and the 3rd arrow in particular, which focused on structural reforms in the Japanese economy, improvements in corporate governance, and encouraging companies to do more for shareholder returns. And as a consequence of that, we've built exposure within AVI Global Trust to a number of companies in Japan that look remarkably cheap. Most of them have got large amounts of surplus net cash sitting on the balance sheet, which has been built up over many years and depresses returns on equity. And we've taken a constructive activist approach to those companies to identify businesses that are growing, businesses that are cheaply valued, to become a proactive shareholder, to engage in dialogue with management, to try and encourage them to improve corporate governance, improve their focus on shareholder returns, and utilize the force of the corporate governance code and the stewardship code that was introduced 6 or 7 years ago in Japan, and get companies to do more to get the share price up. And it sounds remarkable, but for many years, management teams in Japan didn't care about the share price and they didn't care about shareholders. And that really is what's changing in Japan. So we're finding a good number of opportunities there and have built up our exposure over the last few years to that opportunity set.
And there's also, obviously, you launched a separate Japanese trust, which I know you're also the manager of. Is there much of an overlap between the Japanese holdings in this fund and the holdings in AVI Japan Opportunities?
Yeah, there is some overlap. So when you look at the holdings within AVI Global Trust that are in Japan, most of them will be in the AVI Japan Opportunities Trust. But it doesn't work the other way. And that is because AVI Japan Opportunities Trust is about 1/10 of the size of AVI Global, then it can fish in a smaller cap pond, a less liquid pond than AVI Global can. So the overlap is around 35 to 40%. But as I say, where there are smaller opportunities and less liquid opportunities, they go solely into the Japan Trust and don't go into the Global Trust.
Okay, fair enough. The specific question here on Sony, asking what the thinking is behind that holding.
Yeah. So we've owned Sony for a number of years, and it's been a successful investment, although it's faced some challenges the past 12 months. When we first bought it, you could think of Sony as a conglomerate, but rarely for a conglomerate. It had 4 or 5 core businesses that were all doing very well. And the businesses there were the well-known games business, the entertainment business, which includes movies and music, at a financial arm, and also the exposure to the images division, which is cameras that go on autonomous vehicles and in smartphones. All of those were doing well. Each of those businesses on a standalone basis was worth a lot more than the 10 times earnings that Sony as in aggregate was trading at. And there was some activist approach there trying to push management to unlock value. So a lot of that has played out very well. I would say that Sony today is still trading quite cheaply relative to its sum of the parts valuation, but a number of the businesses face some challenges. Well known that the PlayStation has faced supply logistics issues, and growth there will be less spectacular than hoped for. So it's still a holding, but we have taken profits in it over the last few months, and but it's still a good quality business with really great underlying businesses that are all doing reasonably well.
One of the features, obviously, about Japan has been the weakness of the yen recently.
Yeah.
Is that something that you would hedge?
No, we've taken the policy decision not to hedge currencies. The thing about hedging currencies is that it all looks wonderfully clear with the benefit of hindsight, but from experience, I know that it's very difficult to get it right on a sustained basis, and it's not our area of expertise. And we felt that investors in both the Japan Trust, specifically with regards to Japan, and on the Global Trust, with regards to our broad global exposure, generally feel that provides them with currency diversification away from the pound. And although at some points it can be quite painful and disappointing, generally speaking, over the long term, that will come out in the wash. So our approach is not to hedge currencies.
Okay.
And you're absolutely right that the yen has been a big headwind the past 12 months or so. And the reasons for that are well understood in terms of the monetary policy divergence that exists between the US principally and the Bank of Japan. And all of that looks likely to continue. But as we know with currencies, they don't necessarily continue to move in expected or rational directions persistently. And at some point in time, I fully expect that to reverse. From a fundamental perspective, the yen looks remarkably cheap, probably as cheap as it's ever been. And hopefully that will become a tailwind for us, having been a headwind for some time now.
And I'm guessing, I mean, you can confirm this, that the asset allocation is driven really by the stock selection and not the other way around. So you don't set out to invest in North America, say, or Europe, or.
That's absolutely right. We want to have a portfolio that's sort of broadly diversified, and I wouldn't want to have a portfolio, say, that's entirely invested in Japan. That would say quite a lot about valuations and where the opportunities exist. But on top of, but within that, we wouldn't want to sort of target specific weights in specific countries and have regards to specific indices or not. It's much more about the bottom-up ideas and the upside we see from them.
Yeah, because relative to the sort of a global index, you probably like North America, but I'm guessing that just represents a dearth of opportunities there.
Yeah, I mean, the exposure to North America has been creeping up over the last few years. Probably if you went back 5 years, we had very, very little in the way of US exposure. But we over the last couple of years, we've begun to find more opportunities there. and could well be doing more in the future, and valuations there have become more interesting. But generally, we want to maintain a breadth of ideas. We want to maintain a fairly concentrated, high conviction portfolio. So we want individual investments to represent chunky parts of the NAV, and we want the portfolio to look, very, very different to a broad benchmark as well. And that's I think the secret sauce to generating consistent alpha and outperformance.
Oh, okay. I asked you to do a couple of sort of stock examples. So, do you want to talk a bit about Exor?
Yeah.
Please.
So Exor has now been in the portfolio for several years. This is an Italian holding company, and it's controlled by the Agnelli family, who founded Fiat many years ago. And in many ways, this is a good illustration of what's going on within our universe in terms of valuation at times of market volatility. So Exor has a portfolio that is invested across a number of different businesses, having its roots in Fiat, which over the last few years has Fiat merged with Chrysler to become Fiat Chrysler, and more recently it's merged with Peugeot to form Stellantis. So you see that Stellantis still features as a decent exposure within Exor's NAV. A number of years ago, Fiat spun out Ferrari as a separately listed company that was tremendously successful and has been well regarded by the market and trades at quite a premium valuation to car companies, and that represents a large exposure to the company. And they also have exposure to CNH Industrial, which is Case New Holland, which manufactures agricultural trucks and also owns the Iveco trucking business. So a lot of exposure to car related businesses, but different types of exposure there. Last year, they sold their stake in Partners Reinsurance and got a big inflow of cash, and you see that represented there. So today, it's a portfolio that's diversified, that's got a substantial amount of cash sitting on the balance sheet with which to buy back shares and to opportunistically invest. But it's trading on the widest discount we've seen in years. It's trading now beyond the level of discount that we saw it touch during the COVID sell-off, the 50% level. And for a company with a fantastic track record of long-term growth and outperformance that has benefited not only the family, but also minority shareholders such as ourselves, that 50% is remarkable, given that over 20% of the NAV is in cash as well. As I say, the thing we like about it is really a combination of factors. Companies like Stellantis are trading extremely cheaply and look very good value. Stellantis is trading about 1x earnings at the moment. Companies, then the cash gives it flexibility. The 50% discount is really unprecedented amongst European holding companies. And so it does stand out as something that the market is mispricing. It's a real anomaly. And although some of the businesses may face some economic headwinds, fundamentally long-term, we think there's a lot of value in the portfolio.
Okay. And the other one we've got is sort of the Japanese strategy. So WACOM.
Yeah, so we wanted to give you a bit of a flavor for some of the things we're doing in Japan. And as I said earlier on, a feature of most of the companies we're invested in Japan is that they have large amounts of surplus net cash. And because over many, many years, many companies in Japan have built up these cash balances and have never done anything productive with it, the market has gotten used to ascribing little or no value to that cash. So whereas we're quite familiar with doing some of the parts valuations and you add up all the balance sheet assets, cash is ignored in Japan. And hence, companies trade at EV/EBIT multiples that are derisory, extremely low, and getting companies to do more productive things with their cash and to convert those cash into profit and into earnings is one way of getting share prices to re-rate in Japan. So in the case of WACOM is a business that's probably not that well known, but in fact is very important in today's economy. It's got a 60% market share globally in graphic pens for tablets and in tablet production as well. You can think about your Samsung phone uses a pen, that's a WACOM pen. if you're an animation designer, studio designer at Disney, and you're designing animation movies, you're going to use Wacom pens and Wacom tablets. And so it's a business that's growing quite strongly. Its product is considered to be superior to many competitors, hence its strong market share. It's had too much cash on the balance sheet, and it's trading at a high single-digit multiple, which is low for a business that's growing at the rate that it's growing. And we've taken a very large stake in the business. I think we're the second largest shareholder today, second or third largest shareholder. And we've been engaging quite proactively and intensely with management, but in a private, constructive way. So they've gained trust in AVI's long-term objectives. We haven't embarrassed them by going public and insulting them. So the relationship is very, very positive. And they've implemented a number of changes that we've been suggesting in terms of improving the capital structure, i.e. doing more efficient things with cash on the balance sheet, in terms of improving corporate governance, in terms of communication to investors, getting the story out so that investors can recognize what a good quality business is and how cheap it is. And that really, Wacom is one example, but it really is our modus operandi across all our Japanese companies, to get them to really help the market understand just how cheap they are and get the share prices up.
Okay, thank you. There's a question here saying, is there another market like Japan that you could target? And also there's a question specifically about, have you looked at like Korean preference shares, for example, as an opportunity?
Yeah, we have looked at Korean preference shares, and we have looked at Korea generally as another market where there are a number of family-controlled holding companies, and there are reforms being introduced into the country to help unlock some of those discounts that exist within those chaebol structures that exist in Korea. What we've concluded is that the opportunity set is much more limited in Korea than it is in Japan. In Japan, you've got hundreds, if not 1,000 companies that have got over a third of their market cap sitting in idle cash. And you've got a broad-based policy regime that's encouraging all types of companies in Japan by way of the corporate governance code and stewardship code to do more for corporate governance and to do more for shareholder returns. In the case of Korea, it's much more focused on the limited number of chaebols, the family holding company structures that exist. The underlying exposures in those companies tend to be quite cyclical, and you don't have the same breadth of opportunity set or of policy reform that you see in Japan. So I would say it is interesting, but I would say there's not as much to do there as there is in Japan.
Okay.
But apart from Korea, we haven't really found any other markets at the moment that throw up those kind of opportunities.
We talked a bit briefly about asset allocation and not targeting asset allocation. Just to answer the specific question here, you wouldn't hold open-ended funds just to get market exposure then? No,
absolutely not.
So values on a discount and got potential to add value.
Yeah, the one way that we think about our purpose really is to try and do something in addition, over and above what our own shareholders can do themselves. And our shareholders can go and asset allocate, they can go and buy an open-ended fund, they can say they want to have a bit of exposure to a particular segment or sector or area of the global economy. We don't add that much value by doing that. Even where we have overlapping holdings, let's just say we own an investment trust that's held by retail investors, we're always thinking about what we can do over and above what they can do themselves. And often that boils down to being the largest shareholder, being an activist, and engaging with the boards and the managers there to facilitate change. So I wouldn't want to be just replicating and charging a fee for what investors can do very well themselves.
Yeah, it makes sense. Thank you. A couple of specific questions on Pershing Square. So one is what can be done to close the discount? Another one is, do you think, because it is buying back stock, that the manager is slowly taking it private?
Okay, well, look, discounts are notoriously difficult, and we know from our own experience that you need a number of stars to align in order to get discounts in. You need to have good performance, you need to buy back shares to help things along their way, and you need to get out there and tell investors the message and get them to buy into what you're doing. And in our case, you pointed out to our 11.7% discount. When I became the manager in 2015, we were on a 14 or 15% discount. And last year we were down to a 6 or 7% discount, and everything was looking great. And now we're back out on an 11% discount. So, which is frustrating, but that's the nature of discounts. And one has to be persistent and consistent, keep doing those things over time. I would say that Pershing Square are doing a lot of those things and have been doing much more of the right things the last few years. So they've been getting out there, telling the message, they've been buying back a large number of shares, and their performance has been fantastic. And the reason you see it there as our largest position is just we think that the discount on offer today, north of 30%, at times it's been north of 35%, is just really an anomalous opportunity to be able to buy a high quality portfolio with a very good management team on such a wide discount. And as I say, that they're doing the right things, and it's frustrating for us, it's frustrating for them that the discount remains wide, but I'm confident they'll continue to keep buying back shares and keep marketing and keep hopefully delivering good performance. And hopefully over time, the discount can narrow. As to the sort of the second question, clearly there's a large insider stake. The manager owns 25%, I think. I don't think it's their objective to buy back shares so that they're privatizing it. I think genuinely there's an alignment of interest here that the management team want to get the share price up. They want to get the discount down, and clearly it's in their interests to do so. And I don't think they're looking. I don't think we're suffering as minority shareholders from that trend, that direction of travel. It's very accretive for them to be using their cash to be buying their shares at the kind of discounts we see today, and I see that as a positive alignment of interest.
Good. Okay. Oakley Capital's on there. And we've seen quite big discounts on all sorts of private equity funds in the UK. Why is that one your sort of favourite one? And do you see any reason why that discount's going to show?
Yeah. Okay. So by way of background, in terms of Oakley Capital, as you recall, it's had a checkered history when it comes to corporate governance. And we bought our stake several years ago on the basis that checkered history of corporate governance, poor corporate governance, was coming to an end and was not going to be repeated. And on the back of the commitments that were made not to issue shares at a discount, for example, we acquired a stake, and it's been a very, very successful investment for us over a number of years. And that success comes about from a clear focus from the Oakley team on certain areas of opportunity, a conservative approach to reporting NAV, which has meant that realizations have come at healthy premium to reported NAVs, and an opportunity set that is really generated from within their own network and within their own universe of companies, rather than relying on public auctions and having to overpay for businesses. So all of that collectively has meant that it's been a core exposure for us for a number of years. It's meant that NAV performance has been extremely strong, and it's meant that the discount has been on a narrowing trend, albeit that, as you allude to, over the last 6 to 9 months, that discount has widened out again, along with the rest of the sector. So what I would say is that we think at the 37% or so discount that Oakley Capital is trading at today, it's very attractive. We think the NAV is reasonably conservative, and to the extent that discounts are pricing in further falls in NAV potentially, we think the one in the case of Oakley, that's unwarranted and would be attractive. With regard to what's going to lead to narrowing of the discount, I think we are in a market environment in which discounts generally widened across the sector. So continued NAV performance, continued realizations above reported values, continued transparency on what they're doing, supplemented by share buybacks, and the improved corporate communication that we've seen ought to lead to a narrowing of the discount, particularly when markets settle down and we can return to a more settled environment.
You've got a stake in KKR, and I don't think it is the biggest thing that the biggest company that you're invested in. But if you've got something like that, which is a very big corporation, can you actually have any kind of influence over what happens?
It's not so much in the case of KKR about having influence with them. It's about identifying a company that we think is mispriced by the market. It's about investing in a company where we think that the interests of the senior management team is aligned with that of minority shareholders such as ourselves. And that very much is the case in the case of KKR. KKR and Apollo, which we also own, are well-known alternative managers, alternative investors. There's a sense in the market that they're all about private equity, and hence in a risk-off environment that we've seen over the last 9 months, their shares have underperformed miserably, and when markets go up, they do well. We would argue that sort of misses the point here. Both KKR and Apollo benefit from having large pool of balance sheet assets that are not very well valued by the market. They're trading very cheaply to management fee revenue that in many cases is pretty resilient and pretty visible for the foreseeable future, and not dependent upon successful exits and big performance fee generation. So we think it's trading very, very cheaply on both an earnings basis and on a sum of the parts basis. And that as we go through this difficult time in markets and the company continues to generate the resilient earnings that we've become used to over the last few years, I think markets will reconsider how those companies are valued.
Okay, thank you. In terms of your dividend, do you have it? What's the sort of dividend policy for the fund? There's a question here about whether dividends might grow or not.
So the stated policy, which is a board policy rather than the manager's policy, is to, at the very least, maintain dividends, so not to cut dividends, to use the reserves that we have in order to ensure that the dividend is maintained, but ultimately to have a progressive dividend policy over time. So I think I'm right in saying that over the last 20 plus years, we've not cut the dividend. We've at the very least maintained it, but the board's objective is to try and grow that dividend over time.
Okay, thank you. Couple of things just on the team. So do you want to say a little bit about the size of the team and the number of people who are dedicated to analysing stocks on behalf of the fund, please? And then also, because it always pops up, and the extent to which you and the team have got an investment in this fund, and maybe AVI Japan as well.
Okay, so the investment team at AVI has been growing fairly consistently over the last 5 or 6 years. So we're 12 or 13 investment professionals. 3 or 4 of those are dedicated to the Japanese opportunity, which obviously benefits the global trust as well. But we've made a conscious decision to invest in the team over the last few years and to expand it. And the reasoning behind that is when you think about what it is that we're trying to do, which is find opportunities that are overlooked by other market participants, one of the areas in which the greatest opportunity arises is companies that don't have much in the way of sell-side research. So doing our own research internally, knowing these companies inside out better than anybody else is our objective. And in order to achieve that, we've grown the team quite substantially. So there's myself as the lead manager. There's Tom Trainer, who's the head of research and effectively my number 2 on the AVI Global Trust. And then there's a series of analysts who have been with us for between 1 and 15 years. So quite a lot of experience on the team as well.
And in terms of investments?
Yeah, so I don't have the numbers for the whole of AVI to hand. But in terms of my own personal investments, well over 90% of my liquid assets are invested into AVI Global Trust, AVI Japan Trust, or other vehicles doing the same thing but different structures.
Good. That's encouraging, I think.
Yeah.
So, well, good luck with it all. Thanks very much for doing this. I think we are going to get you back to talk about the Japanese fund at some point in the next couple of months. Great. But thank you for doing this today. So,
thank you very much. Thanks for having me.
We will be back next week talking to Alliance Trust and Stuart Gray from Wisthouse Watson, who's the management fund. And then we've got more things lined up there. It may be that AVI Japan ends up in that 14th of October slot. We'll wait and see, but I think we're talking to other people about that too. So thank you very much for tuning in today. As I said at the beginning, it's been a sort of a strange day, but there we go. And we'll hopefully see you next week. Bye-bye.